welcome to The Explainer. Today, we're piecing together the really complex economic picture for 2026. Using insights from some of the top financial analysts, we're going to explore the powerful and, sometimes conflicting forces that are shaping our world. Okay, let's dive right in.
So, what's the big picture for 2026? Well, if you're looking for one simple answer, I'm afraid you won't find it. The short version is, it's complicated. As we're about to see, the world's major economies aren't all marching to the same beat. In fact, they seem to be heading down very different paths.
Now, what's really fascinating here is the sheer divergence this shows. According to analysis from Goldman Sachs, the U.S. is looking at a potential rate cut this December, mostly because of a weakening labor market. But then you look across the Pacific and it's a totally different story. The Bank of Japan is actually likely to hike rates, all thanks to some pretty robust growth. And Europe, well, it's charting its own course entirely. This is not one single global economy. It's a collection of very separate stories playing out at the same time.
Hey, before we go any further, just a quick reminder. Please don't forget to subscribe to my channel, turn on that notification bell, and of course, share and like my videos. And as always, remember that the information in this explainer is not investment advice. Thank you.
Okay, so how do these huge, high-level economic shifts actually affect people in their day-to-day lives? Let's zoom in a bit and look at household finances, starting with the immense pressure on savers.
And here we can see one of those consequences in pretty stark detail. Over in the UK, a really worrying trend has popped up. This chart shows a sharp 20% decline in average monthly pension contributions in just 6 months. We're talking a drop from over £65 to just over £53. That's the first sustained drop in 2 years, and it's a clear signal that households are really feeling the squeeze. This situation has prompted some pretty stark warnings. For instance, the Shadow Pension Secretary, Helen Whatley, has warned of a looming pension poverty time bomb. Now, critics from her party argue that certain government policies on taxes and the cost of living are what's forcing people to dip into their retirement savings just to stay afloat. It just goes to show you the very real political dimension of these economic pressures. All right, now let's pivot and look at one of the most powerful forces shaping the future economy. It's a complete contrast to the pressures we just saw on savers. I'm talking about the artificial intelligence revolution. 27%. Just let that number sink in for a second. It's staggering. According to Goldman Sachs, a full 27% of all capital expenditure in the S&P 500 now comes from just 5 of the biggest AI hyperscalers: Amazon, Google, Meta, Microsoft, and Oracle. This signals an incredible concentration of investment, a massive bet that AI isn't just a cool feature, but the absolute fundamental infrastructure of our future.
But this digital boom has a very real, very physical cost. The massive power demand needed for all these new data centers is creating what analysts at Goldman Sachs are calling a structural mismatch. Basically, the technology is advancing at lightning speed, but the physical power grids, the infrastructure, well, on average, it's about 40 years old, and it is really struggling to keep up.
And this brings us to what is really the central tension of 2026. Because while these unprecedented amounts of capital are pouring into the digital world of AI, there's an equal and opposite force pulling investment toward the oldest physical asset of all, gold. So why the big rush to hard assets? As you can see here, it's basically a perfect storm. Precious metals like gold, silver, and platinum started 2026 with a major surge. This whole thing is being driven by these persistent concerns about currency debasement. The idea that your money is losing value because of inflation and government policy. Add to that unresolved government debt, heightened geopolitical tensions, all while central banks just keep on buying. And this isn't just speculation. We're talking about significant investment. According to data from Saxo Bank, total holdings in gold-backed ETFs hit a 3-year high of almost 99 million ounces. Now, to put that into perspective, the net inflows in 2025 alone basically reversed the combined outflows of the previous 3 years. That's a huge shift.
So, with these two powerful, opposing forces at play, the digital engine of AI on one hand and the physical anchor of gold on the other, where are investors looking for new opportunities? Let's take a look.
So where is the savvy capital flowing? Well, analysis from giants like BlackRock and Goldman Sachs points to several key areas, things beyond the obvious. First up, emerging market debt is getting a lot of attention for diversification and higher potential returns. Then there's private credit, which is booming as traditional banks pull back. We're also seeing a massive flow of capital into the energy transition and the circular economy. Think next-gen solutions for waste, water, and recycling. And finally, the reorientation of global supply chains is creating brand new opportunities. Honestly, each one of these could be its own explainer. At the same time, the very platforms that investors use are evolving rapidly. I mean, take Robinhood, for example. They're expanding into totally new asset classes like futures and index options. The goal? To become an all-in-one financial ecosystem to meet the search for growth and, of course, capture a bigger share of the next generation's wallet.
All of this brings us to the crucial point, the main thing to consider as we look at this really complex landscape of 2026, a landscape that's defined by all these competing trends and powerful forces we've talked about.
Ultimately, the economic story of 2026 is a story of tension. It's a tug-of-war between the intangible value of digital code and the tangible security of physical gold. And it leaves us with a final, provocative thought. In a world being pulled so hard in these two opposite directions, where will durable, lasting value truly be found?